Good afternoon, everyone. Today I'm chatting with Mike McGlone from Bloomberg. In today's interview, we get into what's happening with the price of gold and the price of Bitcoin and what Mike thinks will lead to the next recession. All right, everybody, enjoy the interview. Mike, thanks for joining us.
Oh, it's good to be back on, Steve. Thanks for having me. It's been a while.
Well, I appreciate you hopping on because you have been one of the guys who's been right about these markets. Back in June, we had you on. You called $4,000 gold when very few people were willing to put their neck on the chopping block and get it right. We're $4,200 at the time of filming. So, Mike, when you look at the price of gold right now, what's going through your head?
I appreciate you remembering some of the few I get right because I used to have hair, and putting your neck in a chalking block sometimes can be a little risky. What's going through my head right now is gold is just plain scary. The velocity of this rally up 60% in the year. Last match in 1979. I was a teenager then. I remember it a little bit, just talking about it with my friends, but certainly not invested. But that was a significant discombobulating period of massive inflation in the U.S. It was right before the peak in inflation, and basically marked the end. Volcker came and shut it off. But all the ratios really scare me. So when every major risk asset on the planet underperforms the rock, the ancient store value, it's not a good sign. And what's unique about this year, so I did make this tilt last year when I saw Bitcoin reach out on 1,000, that it's time for be a down year for risk assets, and I fully expected cryptos to show some peaking activity and gold to be the best performer. What's really notable this year is, if you had told me at the end of the year, that by this time this year, that gold would be up 60%, I fully would expect it. Yeah, sure, the stock market would be down. US would be kind of tilting towards somewhat of inflation, and then cryptos and Bitcoin would have a major problem. But that's not what's happening yet. Is what I'm really more worried about. So we're at the stage now. We're getting towards, we basically have the last 2 major months of the year left. That's basically October, November, and then December basically shuts down. And just a few weeks ago, 90-day volatility on the S&P 500 bottom from a 5-year low. It hasn't been that low since just at the start of 2020, right before COVID picked up. So volatility in the stock market might be picking up. At the same time, we've seen all these ratios that really scare me kicking in. The key one I really like to watch is the ounces of gold per one Bitcoin. Right now, it's at 26. The peak was 40 when Trump got elected. It dropped to 25, back up to 38. It looks like it's heading back down, and for a good reason. If stock market volatility is bottom, that Bitcoin Go ratio, that key leading indicator, looks like it's going to continue to head lower. So what I see is risks of what I first started writing about in June. I put Bitcoin, the potential for Bitcoin to spark the next U.S. recession, in the same headline. And I did it again just today's the 15th, published on that October 15th, where I see cryptos and Bitcoin have 1929-ish or inklings that they might just continue to mean revert, which means leading indicator for everything, the significant wealth creation we've had globally, most notably in this country, is due for some mean reversion. And it's I view it as very scary. I guess the best way to pivot to this is what stops this train. Gold right now is 4,200 an ounce on a 40, 50, 60-month moving average basis, and even versus a 100-day. You've got to go back to like the peak around 2011 or 1981 for similar stretch. So it's very stretched. And so I look at what's this going to mean by the end of the year. So the key thing I'll end with is, right now, we have the Bloomberg Galaxy Crypto Index. It's up about 10% in the year. It was up 30% for a while. We're getting to the point in the year, I think, we could hit significant sell stops in this highly speculative space, so it can drag the whole space down. And one of the key signals for major problems in the global economy is gold going up and crude oil going down.
So what does that mean? Like if I am the butcher, the baker, the candlestick maker, and I haven't, seen that bad of inflation over, say, the last year that I did a few years ago, and I'm looking around and I'm trying to understand what $4,100 gold means. Does it mean that we may see inflation come back and rear its ugly head? Is gold sort of that signal flare that inflation is going to come back?
Actually, it's the opposite, unfortunately. Typically, gold rallies a lot in two environments: currency debasement and inflation, which is what we saw in the 70s. And you've seen a lot of current countries in the world who have debasing currencies. And then significant deflation, which is what we saw to um, the great financial crisis. In China right now, we have significant deflation. And I think the rest of the world is going to potentially follow that lead. PPI is running -3%, about 10-year note yields wanting 1.84%. In the US, it's about 4%. Obviously, the US is catching up a little bit. That's despite the fact that their debt to GDP is running around 300%, which is some measures. One was from Goldman Sachs, and their money supply is running around 45 trillion, which is about double the US. So they're pumping massive amounts into their economy, just like Japan did in the 90s, and just like the US did after the great financial crisis. Um, to avoid that deflation. And there's one key pillar holding up everything, Stephen. That's the U.S. stock market. It has to stay up. So I see right now S&P 500 total returns around 15%. 30, as I mentioned, 90-day volatility just bottomed from a very low level. If we just get a little bit more issues with the stock market going down into the year and everything trickles down. So here's what's happening. Crude oil's down about 15% this year. Grains are falling, iron ore is falling, bond yields in China are lower. There's a lot of signs that there could be more deflation, and it also takes as a trigger. The leading iceberg for all that, the tip of the iceberg for that are cryptos, and they look like they've peaked. So I've been like to point out, so we're just getting to the point where we might be hitting more stops in the space. That Bitcoin to gold ratio looks like it's rolling over, and I'm very concerned. So I think what this means for as you mentioned, the candlestick maker is there's times in your life you can um, be invested in risk-off assets like treasuries. Gold was a risk-off. It's not the time to buy now. It's too expensive. And just sit back and relax. And I think it's one of those times. I put out a piece a little while ago. As your risk manager, if you've made a lot of money on the last 15-year basis, the first time we got this much return on a 15-year basis, which is 600% in S&P 500 total return, was 1929. And then the only time in history we got much more than that was the peak to 2001. You're supposed to take money off the table and just, it's called taking profits. It's a good problem. But this is what usually happens with human nature. People get too extreme. You have markets get too stretched. They get over leveraged. And then we get some normal reversion. So to me, that's what gold's telling us. Problem is gold's expensive now. And one of the key things I'm really worried about is maybe copper will follow that gold's lead lower. So I look at one key thing I'll end with is it's happening this year is treasury bond yields are starting to drop. Now this whole currency debasement thing is silly. When treasury bond yields are falling, that's supposed to fall when there's currency debasement. So it shows my tilt that gold might be shifting towards that deflation that typically follows inflation. Historically, it's always happened. And it's happening in China. Germany's kind of close. Europe's got major issues. And if the U.S. stock market falls, which gold might be predicting, everything just goes back to kind of like we did in 2008, 9, and basically what we did from 2000 to 2002. So I'll end with this. The Fed just started easing, right? And there's a complete consensus that everybody's going to, the stock market's outperform in an easing environment. But I remember clearly when the Fed started easing in 2001, it was the first business day of the year. After that, stock market dropped about 55% to the low. And then when they started easing in September of 2007, after that, the stock market dropped about another 50%. And right now everything's great, but that's when I think gold's telling us there's issues here.
Okay, so just trying to understand where you think we should be heading here if we're trying to allocate our capital. It sounds like you think gold's getting a little bit toppy here at
Oh yeah.
$4,200.
Oh, sure. Gold's too stretched. It's just so stretched. It's extremely stretched. Like I mentioned a few. I look at it. You just go back historically versus moving average. It's so stretched. It's not a level you want to be an aggressive buyer. And there's a pile-on factor. One thing that's really significantly happening. Obviously, no central banks are buying, but it's hard to measure. I was just bantering with some of our research strategists about measuring the amount that central banks are buying. But one thing that's significant about is ETF inflows. We've had 4 years of outflows, and it's just shifted the inflow significantly in ETF. So gold's, investors are picking it up. It's about time because the key thing I'm worried about now, if you look, is take the current S&P 5 total return divided by gold, go back 100 years, it always goes up. But since 1997, it's flatlined. that is not a good sign. So maybe it's a sign gold's getting a little too expensive, but I think it's all of a sign that U.S. stock market is just too expensive. So I just been, to me, that's the whole issue. Is we're at the stage now where we have this very controversial president, and gold market just loves him. Every time he pushes back on the Fed and free market capitalism and things like, kind of made America great, and that's like Fed independence, gold just goes up. So I think this is a signal to me. Gold's telling you you're supposed to be lightening up on all risk assets, and focus on just simple things like. So I'm afraid what's going to happen now is if you go back, another measure I like to use is gold versus everything. But if you go take gold versus a total investment in U.S. Treasuries across the curve, I have a piece of data in the terminal. You got to go back to 1983, the last time the Treasuries prices and the yield, but prices were this low versus gold. So to me, the tilt is if we get just a little bit of deflation, just a stock market maybe ending the year up 5%. I didn't say down. That shifts everything. It kicks everything in, and cryptos are a leading indicator for. To me, that's what I'm getting from. I'm hoping within a few months this will not pan out, but to me, those are all the signals that we're getting right now. And gold is the leading edge. It's just a problem is when this ancient store value, everything underperforms it, something's wrong.
So let me ask you this then. You think gold's getting heavy? What would your reaction be if in 6 months gold's above $5,000? What does that tell us? That there's much bigger issues at play, that the debasement trade might be right, or do you just can't even believe that would be a possibility?
Oh, and everything's possible. Don't know. It's hypothetical. We'll see. For now, it's telling me that if you've been, let's put it this way: anybody who's been invested in gold, some of us who just kind of overweighted, you're overweighted, versus other risk assets. So it's always prudent to take some profits. Um, but I don't know. 5,000 is just so extreme. But a scenario that can kick that in is some kind of displacement. I don't think so, but I'm afraid that if we get to 5,000, it might meet the S&P at the same price. So the key indicator I like to watch is S&P 500 in terms of the ounces of gold. Right now, it's 1.59 ounces per one S&P 500 of gold. The peak was 2.6. Historically, it's closer to 1.1. It could go back to 1 to 1. In fact, it should go back to 1 to 1 points. Question's where. So if we get 5,000 gold, I think that's good. Makes sense. And say if the S&P 500 goes back to 5,000. And right now it's 6,000. It's 6,668. Unfortunately, it's not a good number. Remember, bottom at 666 in 2009. Kind of scary.
Are you paying attention to any of the quote unquote esoteric metals? Because we've seen a pretty big run on some of these stocks, whether we're talking about antimony, niobium, cobalt. Some of these equities are just doing phenomenally well out there. Electro battery metals. They've currently got a 75 cent placement, and the stock hit. I think it hit a high of $9 on the Nasdaq. So you can imagine all the funds who are in that one are pretty happy. What's your view on those metals? You think that this is just like one of those standard little blips where everybody's kind of running in, or is there a real opportunity there?
Well, I'm glad you mentioned it because it's hard to invest directly in those metals. I focus on the underlying commodities. I have commodities colleagues who focus on the equities, and obviously, all the miners are doing great this year. I mean, they caught up. They've been really lagging behind. Most notably, gold miners. I don't know how much further that goes, but the bottom line for me is gold's lifting the whole metal sector. I mean, platinum versus gold back in June was the lowest in our database going back 35 years, and platinum's starting to call out. Now it's the best performing major metal. Now, some of the other more peripheral metals I can't really track so much. They don't trade in listed, active futures. But the key thing I wanted to point out is look at gold silver. I mean, that ratio goes. You can go back a couple hundred years with gold silver ratio. And it reached 105 ounces of silver per 1 ounce of gold back in April when volatility was just peaking and stock market was spiking, and it bottomed. It rolled over and went down. It got too expensive at 105. I mean, historically, it's traded below 50. And the low just recently has been around 78 ounces of silver per 1 ounce of gold. That's been a good support level around 80 for a couple of years. And so I look at that as okay. buy, sell, and it's a level to be looking to buy. Gold versus silver ratio, expect to go up. And the key thing that make that go up is U.S. stock market going down. So the key thing I want to remember on the entire metal sector, and reemphasizes my view that metals in terms of commodities almost always the best sector to invest in historically. You get the best returns, the lowest cost of carry, the least elasticity, and it's proving that this year. So I'll tilt over to what I really know in that space, and that is I watch this. There's an ETF I used to be in the sell side of. I just watch it now. Glitter, GLTR. It tracks precious metals, gold, silver, platinum, palladium. It's the only one really out there. It's up 70% this year. The key thing to remember about what's happening in space, there's only 4 major precious metals. Now, you mentioned some other, um, you know, less significant metals, but are very important, but hard to invest directly in. It's up 70% this year. I overlay that with the Bloomberg Galaxy Crypto Index. The Bloomberg Galaxy Crypto Index has basically 3 to 4 times the volatility. It trades as this metal index, yet it's up only on 10% this year. And a year like that with the stock market up, something's wrong. It's telling you when you have the high performance, high volatility, high beta assets lagging simple precious metals, something's wrong. That's why, to me, everything kicks in if the stock market goes down. That kicks in those deflationary forces that Gold's pointing out. But as far as all the other metals, yeah, it's good to see the underlying the miners kick in, because I know a lot of investors have been asking for years. So I'll end with this. This is the 3rd year in a row we've had a lot of metals conferences in Miami. It's a cool thing. That's what's happening in Miami. They're coming here for 2 years in a row. That was the number one question at every metals conference: is when are the equities going to catch up? When are the equities going to catch up to the underlying, most notably gold? And I kept pointing out, well, at some point, but central banks aren't buying, they're buying the underlying. But it's good to see that this year. For instance, GDX is up, 70 or 80%?
Yeah, and it's also, um, we look at it though, in order for the margins to really expand, gold had to go on a run like this to really make it kind of attractive for the mainstream investor, right? Like a lot of these companies back in say 2010, their ASIC per ounce of gold was, $1,200. Today it might be sitting around $1,600, but it's a heck of a lot more attractive when gold is trading at $4,000 than $1,500. So I think that has somewhat woken up those stock pickers, we could say, or portfolio managers that didn't really care that much about the sector. It's now sort of like, okay, well, some of these mining companies are turning into printing presses. It's time to
Right.
hop in.
Yeah, so I just to correct myself, the VanEck Gold Miners GDX index is up 138% this year, but it was lagging for 2 years, so that's a great catch up. It just the question is probably not a good level to be overweight in those positions, particularly for people who've been waiting this out for years. It's finally just got caught up.
So we always have you on here, and you always seem to have some sort of prediction that we get to kind of hold your feet to the fire on. Last time you were right with the $4,000 gold prediction. If you are chatting to anybody in our audience that's trying to figure out how to allocate their capital during such a volatile time, what's your suggestion here? What, or at least what's the things that you would urge them to think about?
There's a saying in markets, you're supposed to be buying when they're crying. There was a lot of crying in 2020 in the lows, certainly when Bitcoin reached 10,000 and recovering there from there. And you're supposed to be selling when you're yelling. So my prediction is that Bitcoin is on pace, and most cryptos are on pace to probably drop 80 to 90% from their peak, from drop to zero. I made the same prediction in 2018 about Bitcoin when it was around $10,000, and it dropped to 3,000. So I was only 70% right. Making the same call now. It's very bold, I admit that, but it's just based on the facts of unlimited supply, massive speculation, a lot of hubris in the space, over leverage, and the key thing is um, markets go down, commodities go down typically because they went up too much, and having 25 million of them versus only one in 2009 is silly. So also now we have a president in his administration completely has a vested interest in this space going up, which is kind of scary because the old school people I think are maybe did a bait and switch with the president, say, hey, we've been along this space for years, we made a lot of money, and now that he's in, I think there's some of them are selling. But to me, that's the key prediction I'm willing to make, that this cryptos will lead the next recession by dropping a lot. Things like Dogecoin that track nothing, and right now as we speak are worth $30 billion, should probably go down to $3. I mean, zero. It's just some point that's going to happen. But for that to happen, you need to have a little bit of a reverse wealth effect. We haven't had that in this country. Only 2 years really since 2008 of decent down years for the stock market. And that to me is the key thing I'm worried about. By the end of the year, this is going to really kick in. And I think that will trigger the next recession because we have basically stock market cap to GDP right now about two to three times GDP. That I'm sorry, 2.3 times GDP. That has only been matched in history in 1929 US and 1989 in Japan, and both did not work out well. It's just a question of how long we can stay here and whether the signals and triggers for it to potentially go down. And that to me is what gold's telling us by rallying 60% this year so far.
All right, well, Mike, thanks so much for taking the time to do this. I know you're a busy man, especially at a time when commodities are showing so much strength. I imagine everybody's reaching out, trying to get you on. So we appreciate you hopping on here. I wish you had a $10,000 gold prediction for us for our YouTube thumbnail, because that usually brings us the views. But I understand you're a guy who's thoughtful about these things, understands that all these assets and currencies trade on a relative basis, and we got to be smart about knowing when to take chips off the table. So I appreciate you taking the time and to give us your thoughtful analysis, and hopefully you'll do this with us again sometime soon.
Certainly will. Thanks for having me on.
All right, everybody, thank you for watching. If you enjoyed this interview, please do me a favor. Smash that like button, subscribe, and ring that notification bell. Also, if you want more mining content, check out our website over at thedeepdive.ca.